Today we are looking at a leveraged ETF strategy, 60% stocks and 40% bonds, which historically speaking performs better than almost any other strategy out there. To be fair, it performs even better than going all in into a triple leveraged S&P 500 ETF. That while your downturns, for example during the dot-com crash and the housing crash, are significantly less severe. For this video, I will assume you understand the basics of triple leveraged ETFs, and if not, that is completely fine too. You can watch this video where I go deep into why leveraged ETFs can be amazing on the S&P 500. Now let's dive into this even greater strategy, how it works. So the portfolio allocation we'll look at today is called HFEA's Excellent Adventure, or HFEA in short. HFEA is a famous person in the leveraged ETF space, and they are the original inventor of this strategy, so full credits to them. Of course, I will also link the original forum post down below so you can check it out if you would like. In short, the strategy is basically the classic 60-40. 60 meaning 60% US equities and 40% US treasuries or US bonds. 60-40 is something that has been existing for decades already, and even our value investor bad boy Benjamin Graham approves of this strategy. But instead of the boring 60-40, which generally underperforms the S&P 500, well, we leverage the tits out of the original 60-40. On the one side we buy UPRO, which is a daily triple leveraged S&P 500 ETF. And on the other side we buy TMF, which is a triple leveraged 20+ year treasury ETF. Both have an expense ratio near the 1% mark, but you can also expect borrowing fees on top of this expense ratio. And well, the strategy is very simple from here on out. Every time I want to buy, I make sure I buy 60% UPRO and 40% TMF. And then once every 3 months or once every quarter, I rebalance. That means I sell one and buy the other to make sure I have 60-40 once again. But you can rebalance weekly, monthly or even yearly, whatever you desire. I would strongly recommend playing around with the portfolio visualizer. Link will of course be in the description so you can decide for yourself which strategy you prefer most. And how does the strategy perform? Well, darn good. We are looking at a one-time investment of $10,000 all the way back in 1986. You see the blue line? Well, that is the leveraged 60-40 strategy. The red line is all in into a triple leveraged S&P 500 ETF, and the yellow-orange line is a normal unleveraged S&P 500 ETF. I know the chart doesn't look that attractive right now, but that is because in the logarithmic scale, if I turn this box off, we can see that the competition isn't even close. So the triple leveraged 60-40 strategy turns a one-time investment of $10,000 all the way in 1986 into $12 million today. Keep in mind, going all in into a triple leveraged S&P 500 ETF only returns to $2 million, while a normal S&P 500 ETF would have only turned that $10,000 into $400,000 today. And now let's look at the drawdowns. The same $10,000 investment, but now starting in the year 2000. The same colors for each portfolio, and we once again can see that the 60-40 leverage strategy performs really well. But we can also see that the drawdowns aren't even that bad during the dot-com crash, but also during the 2008 housing crash. So that is a potential. Hopefully you are intrigued, because I sure as hell am. And don't forget, there is a link in the description to this portfolio visualizer so you can play around with it for yourself. Anyways, higher returns while not having as severe drawdowns as an S&P 500 triple leveraged ETF. That is insane. Now, why does it work? Well, there are a few key principles behind the strategy. On the one side, we make use of stocks. And if we look at this long-term S&P 500 chart, we can see that it tends to move right over time, but it especially tends to move upwards over that same time period. And bonds actually have a very similar tendency. They move right like all assets do, but they especially tend to increase in value over very long periods of time. And the fun thing is, bonds and stocks are mostly uncorrelated over time, meaning they move up and down independent of each other for most of the time. But there's this one reason why this strategy performs especially well, and that is of course because stocks and bonds tend to be negatively correlated during a market downturn. That means when stocks go down heavily, normally people flee to safety, and that means long-term treasuries. For example, back in 2020, when the COVID dip happened, we can see that stocks, the yellow line, decreased sharply in value, and at that same time period, bonds went up in value as well. And this sharp increase in value of bonds and decrease of value in stocks was especially prevalent in triple leveraged ETFs. And that gives us a huge opportunity. It allows us to buy the hell out of the dip once it is time for rebalancing. So during the COVID dip, your TMF went up a whopping 100% while your UPRO went down 66%. And let me tell you, having TMF in your portfolio allows you to buy way more UPRO once it is time for rebalancing. And that is exactly what gives this portfolio, the blue line, this insane performance, the rebalancing. So hopefully the rebalancing part is clear, but then you might wonder, why do we use bonds and not some other assets, for example, gold? Well, there are two main reasons that I can think of. The first one is gold doesn't really tend to increase in value over long periods of time, since, well, it's just gold. The whole purpose of gold as an investment is to beat inflation and as a hedge during a market downturn. And other than gold, bonds actually increase in value over time. And the second reason might be that there just isn't a triple leveraged gold ETF. So yeah, hopefully you now better understand the inner workings of the leveraged 60-40 strategy. Keep in mind, the purpose of this video is just to inform you on this amazing strategy. No easily consumable video can ever teach you everything there is to know about such an intricate, high risk, high reward strategy. So I do recommend checking out the links down below. The Boggleheads forum is, for example, a great place to learn about the strategy, and there are also a couple of subreddits you can check out to learn more about this strategy. However, I think there are two more topics we should discuss in this video. First, what happens if you dollar cost average? Does the strategy still perform great? And second, risks. Let's start at the first one. Dollar cost averaging. And of course, even the DCA performs amazing. Investing $100 every single month since the year 2000 would have allowed your portfolio to increase in value all the way to $700,000 US. And this is especially amazing compared to a normal S&P 500 ETF, which would have only increased to 100,000 in value by now. And if we go back all the way to 1985, the earliest this portfolio visualizer allows us, well, that same $100 per month turns into a whopping $8 million today. So it is safe to say that this strategy performs really well even when dollar cost averaging. And this is actually also the strategy that I'm personally using. I am investing every single month whether stocks are up and down with the exact same amount. Risks. And now the last topic we should discuss, risks. First, the obvious ones. Leverage in and on itself can be a risk, but it is also the opportunity we are abusing, so I don't want to focus too much on this one, but the risk is there. Second, volatility drag. This means that a 2 or 3x portfolio never truly performs 2 or 3x the underlying over a long period of time. This is a concern, but so long that stocks and bonds move up over time, I think the risk is manageable. 3, increasing interest rates. As most of you will know, an increase in interest rates forces the value of both stocks and bonds to decrease, and this is quite the risk. So if you are worried for seriously high interest rates, this is for sure not a strategy you should use. I personally do not really foresee significantly high interest rates anytime soon, so I'm personally fine with using the strategy. I believe this risk is quite manageable. And another risk we should discuss is overfitting or backtesting, meaning we are basically choosing which choices would have been best 40 years ago, and we are assuming those choices will still be correct for the next 40 years. However, there is no guarantee that the stock market will perform anything like we've seen during the last decades. There is no guarantee at all that the strategy works, and that is quite the risk. And it is a risk we cannot easily mitigate, to be honest. But to be fair, Any strategy that's based on backtesting or past performance has the same risk baked into it. And of course, there are plenty more risks with this strategy. I cannot possibly name them all in this video, and that is not the purpose of this video either. I just wanted to update you on this amazing strategy, and perhaps it is for you, and maybe it isn't. And both are fine. Everyone's investment journey, and especially everyone's risk appetite, should be different. That said, thank you for watching. Peace.